If you want to understand how investors make money when the market falls, do not begin with a stock chart. Begin with gravity. That is the image I want in your head. Gravity. Because a short seller is not really buying a business the way most investors are taught to think. He is borrowing an asset and then betting that gravity will pull the price downward before the sky punishes him for standing in the wrong place. That is the whole trade, and it is one of the most misunderstood trades in the financial world. The public hears the phrase, short the market, and imagines genius. It imagines men in dark rooms seeing doom before everyone else. It imagines some glorious act of prediction where the clever investor spots the crash, presses a button, and gets rich while the crowd burns. That is the fairy tale. The truth is colder, stranger, and much more dangerous. Shorting is not magic. It is borrowed gravity. You borrow something you do not own, sell it into the market, and hope the price falls far enough that you can buy it back more cheaply later, return the borrowed asset, and keep the difference. That sounds elegant. It can also ruin you, because the most important fact about gravity in markets is this. A stock can only fall to zero. A stock can rise much higher than you think. So the profit on a short has a floor. The loss has no ceiling. That is the first sentence people need to understand before they become fascinated by shorting. The loss has no ceiling. And once you understand that, a great many romantic stories about clever bearish investors begin to sound less like hero stories and more like stories about men standing in front of an elevator shaft, praying the elevator goes down before it explodes upward through the roof. That is how I want you to think about this, not as a trick, as a pressure system, because the source material is directionally correct in one very important way. It explains the mechanics cleanly. Borrow shares, sell them, wait, buy them back, return them. Fine. But beneath that simple explanation sits a much more important lesson about money. There are 3 ways to profit from falling markets. You can borrow gravity directly and short. You can buy a packaged reverse instrument that mimics gravity for a while. Or you can do the oldest, simplest, most Buffett-like thing in the world, sell risk when it is overpriced and wait with cash until gravity has done its work. Those are very different games, and confusing them is expensive. So I want to take you through the whole structure the way I would think about it if I were trying to protect a serious amount of money. Not as a beginner's tutorial, as a map. Because money does not care whether you understand the vocabulary. It cares whether you understand the map. The first mechanism is what I call borrowed gravity. This is the pure short sale. Let us make it painfully simple. Suppose there is a company whose stock is trading at $50. You think that price is ridiculous. Maybe the business is weak, maybe the margins are fake, maybe the narrative is overheating, maybe the accounting smells strange, maybe the market simply got drunk. Whatever the reason, you believe gravity will eventually win. So you borrow 10 shares from your broker and immediately sell them into the market at $50 each. Now you are holding $500 in proceeds from something you never truly owned. That is the first thing that makes people feel clever. They say, I just sold what I did not own. Yes, that is also the first thing that should make them nervous, because from this point forward you are living inside obligation, not ownership. The long investor buys something and hopes it rises. The short investor sells something he owes back later and hopes it falls first. That is a completely different emotional and financial structure. If the stock falls to $30, fine. You buy back the 10 shares for $300, return them to the broker, and keep the $200 difference before fees and frictions. That is the clean version. That is what makes shorting look seductive. But markets are almost never kind enough to stop there. Suppose the stock rises to 70. Now buying back the 10 shares costs $700 you sold for $500. You must now add $200 of your own money just to get flat. That is not a theoretical inconvenience. That is real pain. And if the stock rises to 100, 150, 200, or even more because some mania, squeeze, or new story enters the room, you continue bleeding. That is why I say the short seller is borrowing gravity. But the sky still has authority. Gravity gives him limited upside. The sky gives him unlimited danger. That is not a trade structure to approach casually. Now, many people think the danger ends with being wrong on direction. No, being wrong on direction is only the first danger. The second danger is being right too early. This is why I distrust shorting as a default style for ordinary investors. The market can stay irrational longer than a leveraged short seller can remain calm. Liquid or solvent, that is not a slogan. It is a structural truth. A stock can remain absurdly priced for much longer than your broker remains patient. And while you are waiting for gravity, The carrying cost of your conviction is eating you alive. That is why the next mechanism matters so much. I call it the ceilingless risk. A long position has a natural asymmetry people underestimate. You can lose what you put in, which is painful enough, but at least the damage is bounded by the size of the capital committed. In a short, the asymmetry reverses. Your best outcome is capped because the stock can only go to zero. Your worst outcome is open, ended because price does not recognize your comfort. That is ceilingless risk. I think about it the same way I think about standing in front of a fire. A candle is a bounded risk. A forest is not. A short position can begin like a candle in your mind and then become a forest because the stock's rise changes your obligations faster than your emotions can keep pace. This is why so many investors who admire great short sellers misunderstand what made the famous ones unusual. Michael Burry in the housing crisis was not merely smart enough to see the crash. That is how films tell the story. The deeper story is that he was willing to live through a period in which he looked wrong, felt wrong, and was being billed monthly for the privilege of being right later. That is a much harder trade psychologically. A short seller can be fundamentally correct and still suffer for months or longer because the market's timing and his timing are not the same thing. This is where many people discover they do not actually want to be short sellers. They wanted the emotional prestige of being early without the financial reality of paying for early. That is a childish fantasy. The market does not care whether you feel insightful. It asks whether you can survive the path. That is why the third mechanism matters. I call it the margin noose. You do not short in a vacuum. You short through a broker. The broker lends you shares, and because the broker is not in the charity business, demands protection. That protection is margin. Margin is the extra capital you must keep available, because the broker knows the same thing I just told you. A short can spiral violently against the seller. If the stock rises, the broker's exposure to your loss rises too. What happens then? The broker calls. That is the margin call. And a margin call is not a philosophical invitation to reconsider your life. It is a very practical message saying, bring more money or we will protect ourselves by closing you out. The broker protects itself first, always. That is the law of the margin noose. A short seller who forgets this will eventually be reminded by force, I think. Ordinary people often underestimate how little room there is for ego in this part of the market. They imagine the broker as a neutral platform. No, the broker is a risk manager with better lawyers and less romance than you. If your position moves badly enough, the broker will not admire your conviction. It will liquidate you. This is why shorting has destroyed so many intelligent people. They were not wrong about the business. They were wrong about the path, the financing, or the time it would take for gravity to arrive. That distinction is everything. It is not enough to be correct. You must be financed correctly enough to survive correctness arriving late. That is a very different requirement. Now, let me name the fourth mechanism. I call it the share lender's secret. Most people have no idea where the borrowed shares actually come from. They assume the broker has some magical warehouse of stock floating in the background. Sometimes the source is simpler and more uncomfortable than that. Very often, the shares being lent to short sellers come from other investors whose accounts permit lending. If you hold stock in a margin account, the broker may be allowed to lend those shares. Some brokers also have voluntary lending programs where investors explicitly opt in to let their holdings be borrowed in exchange for part of the borrow fee. That means the market contains a strange little hidden ecosystem. One person owns the stock because he is bullish. Another person borrows that same stock because he is bearish. The broker stands in the middle, facilitating the relationship and protecting its own balance sheet. And the long holder may earn a small payment simply because someone else wants to borrow his optimism and reverse it. That is one of the more elegant and slightly absurd truths in markets. Your shares can become another person's gravity trade. This matters because it shows you that shorting is not only a bet, it is an infrastructure, a chain of collateral, permissions, fees, obligations, and priorities that sits under the trade. And once you see the infrastructure, you stop speaking about shorting like it is just another opinion. It is not merely an opinion. It is a financed, borrowed, collateralized structure that can turn against you mechanically, even when your thesis remains intact. That is why I prefer maps to slogans. Now let me name the fifth mechanism. I call it the reverse gear. This is where most ordinary investors first think they have found a safer alternative. They hear about inverse ETFs, a fund that rises when the market falls. Wonderful. No borrowing shares, no margin account to manage directly. no theoretically unlimited loss from a naked short position. It sounds perfect. And for a brief period, for a very specific purpose, it can be useful. But the reverse gear is not the same thing as borrowed gravity. It is a packaged daily instrument. That phrase matters. Daily, an inverse ETF is designed to produce the opposite of the daily move of an index or asset. That is a very different promise from, it will always mirror the opposite of the market over long stretches. The public hears reverse and imagines a clean mirrored world. That is not what it gets over time. Because the fund resets daily, the path matters enormously, volatility matters, sequence matters, choppy markets can erode the value of the inverse ETF, even if the broad directions seem to support your thesis. This is why I think of inverse ETFs like a reverse escalator. If you are trying to walk upward on an escalator, moving downward, your experience depends not just on where you want to go, but on how the escalator is moving under your feet each day, over long periods. The compounding math can make the inverse ETF drift in ways casual investors do not expect. That is why I say the reverse gear is for tactical travel, not for permanent residence. Used intelligently over short windows, it can help used lazily as a long-term substitute for a thoughtful bearish strategy. It can disappoint badly. The market does not hand out free reverse gears. It hands out temporary tools with hidden decay. This is why so many ordinary investors get hurt with instruments that were marketed as simplifications. Simplicity of access is not the same as simplicity of behavior. You can buy the inverse ETF more easily than you can run a traditional short. Fine. That does not mean you fully understand the machine you are now sitting in. Now let me name the sixth mechanism. I call it the cash fortress. This is the oldest bearish strategy in the world and still the most Buffett. Like you do not borrow gravity. You do not buy a reverse package. You simply reduce or sell overpriced exposure when you judge the odds unfavorable and wait with cash or near cash until gravity has finished enough of its work that the odds improve. Again, this sounds almost too boring for the modern imagination. Good. Boring is often where the real edge lives. The public loves clever bearishness because clever bearishness flatters the ego. It lets people feel like they are not merely prudent. They are sophisticated. They are seeing through the matrix. They are Michael Burry in a better sweater. I do not care about any of that. I care about asymmetry. The cash fortress is asymmetry without theatrical risk. If I sell something overpriced and hold dry powder, my upside is not unlimited. True, but my downside is bounded, and my optionality rises as prices fall. I am not being billed to stay right. I am not paying borrow fees. I am not praying a squeeze does not arrive. I am not getting margin calls because some nonsense stock doubled on a rumor. I am simply waiting. People underestimate the financial power of waiting because waiting feels passive. It often is not passive at all. It is strategic conservation of firepower. The short seller tries to make money as the asset falls. The cash holder tries to preserve money so he can own more of the asset once the fall has done enough damage. Those are different philosophies. I have always found the second philosophy more durable. It fits my temperament better because it respects valuation without borrowing drama. A lot of ordinary investors hear about shorting and imagine it is the only way to profit from decline. Nonsense. A huge amount of wealth is built by refusing to overpay in booms and being liquid enough to buy in busts. That is not glamorous enough for movie scripts, but it is plenty effective for real balance sheets. Now let me name the seventh mechanism. I call it the negative conviction test. This is where the whole subject becomes personal. It is one thing to say you think a stock is overpriced. It is another thing entirely to build a position that profits from being right while surviving the possibility that the market humiliates you first. That is the negative conviction test. A good short seller must not only dislike a business, he must understand the timing problem, the financing problem, the squeeze problem, the margin problem, the borrow cost problem, and the psychological problem of standing against a crowd that may still have far more money, momentum, and stupidity available than he expected. That is a serious test. Most people do not want to pass that test, and that is fine. I think one of the great mistakes in finance is confusing fascination with suitability. A person can be fascinated by the mechanics of shorting and still be totally unsuited for practicing it. That is not weakness. It is self-knowledge. I find a lot of ordinary investors are far better served by learning what short sellers teach than by becoming short sellers themselves. And what do short sellers teach? They teach skepticism. They teach that prices can be wildly wrong. They teach that narratives can crack. They teach that a company's stock price and its economic reality are not the same thing. They teach that the market punishes blind optimism eventually. Those are worthwhile lessons, but you do not need to borrow shares to learn them. You can study short theses to improve your long investing. You can study how bubbles work. You can study valuation. You can study why leverage destroys people. You can study why crowd psychology matters. And then you can choose the style that matches your temperament. That is the adult move, not imitation selection. Now, if you put all these pieces together, the map becomes much clearer. Borrowed gravity explains the basic short sale. Ceilingless risk explains why the upside of the trade is capped while the downside is open. The margin noose explains why the broker, not your ego, determines how long your pain can continue. The share lender's secret explains where the borrow infrastructure comes from. The reverse gear explains why inverse ETFs are tactical tools, not permanent havens. The cash fortress explains the oldest and often safest bearish posture. And the negative conviction test explains why the right question is not can you short, but should you? That is the whole subject in grown-up form. Now, let me tell you how I would speak to a regular investor who thinks the market is overvalued and wants to protect himself or even profit from a fall. First, I would tell him not to romanticize shorting. It is not proof of sophistication. It is a highly specific trade with ugly asymmetry. If you do not understand every moving part, do not play that game with meaningful money. Second, I would tell him that understanding overvaluation is still enormously valuable, even if he never shorts a share in his life. Overvaluation can tell him when to be more selective, when to hold more liquidity, when to stop chasing momentum, and when to prepare for better entry points later. Third, I would tell him that inverse ETFs can be useful only if he understands that they are short-term tactical instruments. They are not magical anti-market savings accounts. Fourth, I would tell him that for most people, the most practical bearish skill is not building a short book. It is learning how to hold more cash when the world is paying absurd prices for fragile stories, and then learning how to buy aggressively when those stories crack. Fifth, I would tell him to separate the thrill of being right from the structure of getting paid. Many people love the emotional idea of calling a crash. Very few structure themselves correctly to benefit from it without being destroyed. In the meantime, that is why I trust the boring fortress more than the dramatic short. I think this is where the lesson of the big short gets distorted by popular culture. People watch the story and think the moral is that genius means spotting the collapse and betting against it. A much better moral is this: if you are going to stand against a mania, you need a structure strong enough to survive the time it takes for the mania to die. That is the lesson. Structure first, ego never. And if your structure is weak, then even a good idea becomes bad capital allocation. Now, let me end where I began. With gravity, markets do not go up forever. Bubbles do not survive forever. Bad businesses do not escape arithmetic forever. At some point, gravity arrives. The question is how you choose to relate to it. Do you borrow gravity directly and accept ceilingless risk? Do you rent reverse exposure briefly through a tactical instrument? Or do you sit in a fortress of liquidity, refuse foolish prices, and wait until gravity lays bargains at your feet? Those are different lives, different temperaments, different dangers, different rewards. I know which one I trust most. I would rather be a patient buyer with dry powder than a dramatic profit being billed monthly for being right eventually. That does not make short sellers foolish. Some are brilliant, some are disciplined, some are exactly suited for the work. But regular investors do not need to imitate every brilliant specialist to become successful. Sometimes they only need to understand what the specialist is really doing and then choose the safer version that fits their own nature. That is wisdom, not fascination. And in money, wisdom lasts longer than fascination almost every time. So if someone tells you he is short the market, do not immediately admire him. Ask better questions. What is he short? At what cost? With what financing? With what survival plan if he is early? With what structure? If the sky ignores gravity for another 6 months. That is how adults think. And if you think that way, you may discover that the smartest way to profit from falling markets is not always to stand in front of them. Sometimes it is to step aside, let gravity do its work, and be waiting with cash when everyone else finally remembers what price means.